Capital markets are places where people with money connect with people who need money for big ideas. They are vast, interconnected networks that channel savings and investments between suppliers of capital and those who need capital. Think of them as the global economy's circulatory system. This system moves financial resources from those with a surplus, like savers, like investors, to those with a deficit, like businesses, like governments funding projects. It is a simple concept, yet its execution is incredibly complex. It involves trillions of dollars changing hands every single day across the globe. This constant flow of capital builds factories, funds new technologies, and allows governments to provide essential public services. The sheer scale is hard to grasp. They represent a monumental pool of global wealth. To put this into perspective, global stock markets recently surpassed $100 trillion. That excludes the larger bond markets and other financial instruments. That's more than the world's annual economic output. It shows how much financial power is concentrated here. This massive reservoir is not static. It is constantly in motion, seeking opportunities for growth and return, guided by millions of participants, from small retail traders to large institutional funds. One of the most fundamental roles of capital markets is to fund businesses. Companies need money to grow. They use it to build new factories, hire more workers, invest in research and development for innovative products. Without access to external capital, a company's growth would be limited to the profits it could generate on its own. This would be a very slow process. Capital markets provide a shortcut. They allow promising businesses to raise large sums of money quickly from a wide pool of investors. This accelerates their growth trajectory. It enables them to scale up operations, compete on a much larger stage than would otherwise be possible, creating jobs and driving economic expansion along the way. Consider the simple act of a company issuing stock for the first time through an initial public offering, or IPO. This is a transformative event. It provides the company with a sudden infusion of cash that can be used for major strategic initiatives. For example, a small biotechnology firm might use IPO proceeds to fund expensive clinical trials for a new drug that could save lives. A renewable energy company might use the funds to build a new solar farm, helping to combat climate change. According to data from Statista, companies raised over $600 billion through IPOs globally in 2021 alone. This demonstrates the immense power of public markets to mobilize capital for productive enterprise and groundbreaking innovation. This funding mechanism is not just for large, established corporations. It is also crucial for the small and medium-sized enterprises that form the backbone of most economies. While they may not be listing on the New York Stock Exchange, these smaller companies rely on different parts of the capital markets ecosystem. They might seek funding from venture capital firms, or they might issue bonds to a smaller circle of private investors. This access to capital allows a local manufacturing business to purchase new machinery, increasing its efficiency and allowing it to hire more people from the community. Think of a small coffee company that started with a single shop. The founders have a vision to source their beans ethically and expand to new locations. Instead, they turn to a venture capital fund. The fund provides a few $1,000,000 for a share of the company. With this capital, the coffee company can open 10 new stores in a year, hire dozens of employees, and establish direct trade relationships with farmers, improving livelihoods abroad. This story, repeated thousands of times, is how markets translate savings into real-world progress. Beyond just providing funds, capital markets play a critical role in price discovery. They determine the value of assets. The price of a company's stock, a government's bond, or a barrel of oil is not set by a central authority. It is determined by the constant interaction of buyers and sellers in the market. Millions of participants, each with their own information, analysis, and expectations, contribute to this process. The resulting market price reflects the collective judgment of all these individuals about an asset's current worth and future prospects. This continuous valuation process guides investment decisions. This pricing mechanism acts as a powerful information signal. A rising stock price suggests optimism about future earnings and can make it easier and cheaper for that company to raise more capital. Conversely, a falling stock price signals concern. It may indicate challenges such as declining sales or new competition, making it harder to attract new investment. This feedback loop forces accountability. Companies must perform well to maintain confidence. This discipline promotes efficiency and good corporate governance. Every day, on the New York Stock Exchange alone, billions of shares are traded. Each trade is a data point, a small vote on the value of a company. The market aggregates these billions of votes into a single, observable price. This is far more efficient and dynamic than any committee or government agency could ever achieve. This process is not perfect. Prices can disconnect from fundamentals, but over the long term, markets have proven remarkably effective at processing vast information and finding a price that reflects true economic worth. Investors, analyzing technology, regulation, and consumer preference, may bid up the EV-focused company and sell the traditional one. The difference in market cap signals which strategy the market believes will succeed, encouraging capital toward innovation and away from outdated models. A third crucial function of capital markets is the allocation and management of risk. Every economic endeavor carries some degree of risk. A new business might fail. A new technology might not work as expected. A government might be unable to repay its debts. It would be inefficient and dangerous for any single person to bear all this risk. Capital markets slice risk and distribute it among many participants. Diversification makes the system more resilient, preventing a single failure from causing catastrophic loss for any one investor. Insurance companies, pension funds, mutual funds. They pool money from millions of individuals, then invest across a wide range of assets, stocks, bonds, and other securities, so losses in one area can be offset by gains in another. Diversification is the bedrock of modern portfolio management. It lets savers participate in growth without bearing the full risk of any single investment. Consider a massive new rail line. Costs can run into tens of billions, with risks of delays, overruns, or low ridership. No single bank should take all that risk. Instead, bonds finance the project, purchased by thousands of investors worldwide, from large pension funds in Japan to individual retirees in Germany. Each investor bears only a tiny fraction. If it fails, each loss is small. If it succeeds, society benefits. This makes large, ambitious projects possible, essential for long-term development. New technologies are risky. Many ventures fail. Without sharing risk, few would try. Venture capital and private equity fund experimentation by building portfolios of many startups. Knowing one or two big winners can more than offset many losses, financing a high volume of ambitious experiments that raise the odds of breakthroughs. To truly grasp the impact of capital markets, we can visualize the connection between financial depth and real-world prosperity. Imagine a chart, a scatter plot titled Deeper Markets, More Jobs. Show x-axis, market capitalization, percent of GDP. Show World Bank label on chart. Show y-axis, employment rate. Show alternative y-axis measure, patents filed per capita. Plot world countries. A rising diagonal pattern appears. Strong, positive correlation. Countries with deeper capital markets have higher employment and innovation. This is not a coincidence. The chart ties ideas we've discussed to visible outcomes. Upper right cluster. Capital flows efficiently to businesses. That fuels growth and hiring. United States, United Kingdom, Switzerland. Lower left cluster. Shallow markets and lower employment. Businesses struggle to get funding, growth constrained, job creation stagnates. The chart is a testament that well-functioning capital markets are prerequisite for broad prosperity. This visual evidence demystifies finance, moving from abstraction to jobs, growth, opportunity. A healthy stock market is not just a game for the wealthy, it supports livelihoods. Capital markets connect ordinary savings through pension, insurance plans to companies that create jobs. It is a virtuous cycle. Expand the visualization to global connections. Use color coding and size variations to show international capital flows. Investment from deep markets supporting emerging economy growth. Capital crosses borders. It seeks opportunity everywhere. This global dimension is crucial. Development in one region can create positive spillovers for others, building a more interconnected, potentially more prosperous global economy for all who participate within it. Despite their immense benefits, we must acknowledge that capital markets are not without significant risks. Their complexity and dynamism can be sources of instability. Market volatility is a primary concern. Prices can swing dramatically based on new information, changes in investor sentiment, and macroeconomic shocks, leading to rapid, substantial losses. Another risk is information asymmetry, unequal access. Large institutions often have better information and technology than small investors, creating an uneven playing field that can undermine trust. The system is vulnerable to misconduct. The pursuit of high returns can incentivize excessive risk-taking, unethical behavior, even outright fraud. History is filled with scandals that shook confidence. The 2008 global financial crisis showed how unmanaged risk can build up and cascade through interconnected institutions. Regulation and vigilant oversight are essential safeguards, not hindrances. There is the risk of bubbles and subsequent crashes when enthusiasm detaches from fundamentals, driving prices to unsustainable levels. When the bubble bursts, wealth is wiped out and severe downturns can follow. These cycles recur. Policymakers must reduce severity without stifling risk-taking. It requires a delicate balance. Let markets function, but have tools ready when excesses appear. Modern complexity and speed, driven by algorithmic and high-frequency trading, can increase efficiency and liquidity, but also amplify volatility and create flash crash potential. A small algorithm error can trigger cascading sell orders in seconds. Understanding and managing these technological risks is a critical frontier for regulators, requiring constant adaptation to keep infrastructure robust and resilient. In summary, capital markets are the powerful engine at the heart of the modern global economy. They fund businesses, discover fair asset values, spread risk across society, and channel the world's savings toward its most productive uses. This process fuels innovation, creates jobs, and ultimately raises living standards. From a small coffee shop to a nation-connecting project, their influence is pervasive, translating financial capital into tangible progress. The data is unequivocal, a clear link between market depth and prosperity. Countries that nurtured transparent, efficient, accessible markets unlocked higher growth and opportunity. This is economic reality, not ideology. The ability to mobilize capital at scale separates dynamic, growing economies from those constrained by limited resources. Power must be handled with care. Risks of volatility, inequality, and systemic crisis are real. Benefits are maximized with strong regulation, transparent practices, and fairness. Trust is the ultimate currency. Without it, the system halts. Maintaining trust requires vigilance from regulators, market participants, and the public. It's a shared responsibility to ensure finance benefits all. Our focus must be markets that are efficient, inclusive, resilient, and fair, opening opportunity to everyone while managing risks prudently. This is how the world's financial engine powers a future of shared, sustainable prosperity. The health and integrity of these markets should concern every single one of us.